No network ayikho.
All right. Good evening, guys. How you guys doing? I hope you guys are doing okay. Now, like I said, this session is gonna be for beginners, very, very basic things. This is pretty much the first session you would have to do. Introduction to Forex, right? Okay, so this is how I'm pretty much gonna conduct the session. I won't really be taking any questions. I don't expect that you should have a lot of questions, especially since you should have been given the modules as well. If you don't have them, just find me on WhatsApp and ask me to email them to you. I will get those to you. So after this session, you should be able to go through the modules with a little more confidence. You should be able to know what's going on. All right, so before I get going, just quickly let me know if you guys can hear me clearly, and then obviously I'll get going. I'll try and finish the session as quickly as possible. It shouldn't take more than 45 minutes. All right, so just let me know in the chat quickly if you guys can hear me clearly, then I'll get going. All right, so I'm getting loud and clear. We're gonna get going. Apologies for that. I was just attending to something on the chat. All right, so here we go. Now, what is Forex? It is the exchange of one currency for another. Okay, so that is basically all that Forex is. Even if you're traveling, something as simple as traveling to another country, you obviously have to exchange whatever currency you bring for the currency that is used in that particular country. That exchange of one currency for another, that is a Forex, or that is a foreign exchange Rather, basically, that is a Forex exchange. Okay, when you exchange one currency for another. Now, the FX market is $5.4 trillion big. That basically means that is how big, or that is how much money is involved and available for you on a daily basis in the Forex market. Okay, so just think about how much or how big a piece or how small a piece of that pie you want to be able to take on a daily basis. Yeah, anything's possible, trust me. All right, now the market is made up of market makers who control 95% of the liquidity in the market, and retail traders only control 5%. Okay, so every single retail trader or every single trader in the world that is trading for their personal accounts or trading in their personal capacities, we all sort of contributes a combined 5% of the total $5.4 trillion up for grabs. The rest of that liquidity is provided by market makers. Yep. Okay, now market makers are very big banks and very big institutions that collectively move the prices of all the currencies that we trade. Okay, nothing happens at random. Market makers move the price. Okay, so when you are trading, your job is to pretty much do exactly what the market maker does. You want to trade in line with what is commonly referred to as the big boys. Okay. Right, so quickly, brokers are companies that we open up our demo as well as live accounts with. They allow us to use their systems to place trades. Okay, so whenever you trade, you cannot trade without a demo. You can, or rather without a broker, sorry. You can if you have millions of dollars. I don't think if you had millions of dollars, you'd want to trade anyway. But you can trade directly with the foreign exchange market if you have a lot of money. For those of us that don't have that kind of money, we still need to trade through brokers. Okay, now brokers, as I said, these are companies that allow us to use their systems to place our trades. Okay, we open live accounts with those guys. Now, like I said, I won't be taking questions in this session. I'll just go through the material. All right, now currencies are always quoted in pairs. Okay, one must always know the value of one currency versus another. Now, for you to be able to make a decision whether you are buying or selling a particular currency, you need to understand what that currency is doing or what it's valued compared to another currency. Is it stronger or is it weaker than another currency? Obviously, if it is stronger than that currency, you will buy it. If it is weaker than the other currency, you will sell it. Now, currencies are written in symbols, which have 3 letters. For example, USD. The first 2 stand for the country, and in that case, it's the United States. The third, the name of the currency, which is the dollar. Okay, so any currency that you are referring to, you will refer to in the symbol or with the symbol. The first 2 letters of the symbol refer to the country, and then the third letter in that symbol refers to the name of the currency that is used in that country. So for example, since we're South Africans, the symbol for the currency, which is the rand, is called the ZAR, or is the ZAR, Z-A-R. Z-A stands for Zuid-Afrikaanse. That's Afrikaans for South Africa. And then obviously rand, or the R stands for rand, correct? So basically any other currency, USD stands for United States dollar, GBP, Great British Pound, JPY stands for the Japanese yen, and so on and so on. All right, now in any currency pair, the USD ZAR, for example, the first listed currency is called the base currency. The second is called the quote or the counter currency. Okay, so very important. First letter, or rather first currency that is listed in any currency pair is called the base. The second one is called the quote or the counter currency. Okay, just hold on for me. Okay, that's the slide I'm looking for. Now, the base forms the basis for the decision to buy or sell. If you believe that the base is weaker than the quote, you are going to sell the base. If, however, you believe the base is stronger than the quote, you are going to buy the base. Okay, so whatever decision you want to take, whether you want to buy or you want to sell, you base it on the base. If the base is stronger than the quote, you buy the base. If the base obviously is weaker than the quote, you sell the base. Right, now the bid is the price at which you will sell to the market. The ask is the price at which you will buy from the market. Okay. Now, the difference between those two prices is called the spread. The spread is what the broker charges for the use of his services and his platform. Okay. So whenever you're looking at a currency, what do they call this thing? Whenever you want to take a new trade, you are always going to be given two prices, right? One, which is the bid, the price at which you can sell at, as well as the ask price, the price at which you are going to buy from the market. Okay. There's always going to be a slight difference between those two prices, and that difference is called the spread. Now, whenever you are choosing a broker, you want to be careful that that broker has what is called tight spreads. That means the difference between the bid and the ask price are not very big. Okay. Some brokers have spreads as big as 12. Some brokers have spreads only as big as 1.5 or even 2. Okay. The smaller the spread, the quicker you go into profit, or the quicker you make money. Okay. So whenever you're choosing a broker, just pay attention to the spread. Also, when the market is volatile, that basically means when the market is jumpy, or the market is going up and down too quickly, you want to stay away from that kind of market. You don't want to trade under those conditions. Okay. You will also be able to see that the market is volatile by the spread. So whenever the market is volatile, your broker will normally increase the spread. Okay. So that's also something for you to pay attention to. Now, the broker will give all its clients what amounts to a loan, which will afford clients an opportunity to make more money than they otherwise would be able to make. And this is called leverage. Okay, so whenever you are trading the Forex market, you trade with what is known as leverage. That basically means whatever you deposit, or whatever amount you deposit, your broker will front you more money to trade with. They will not put that money, or they will not deposit that money into your account, obviously, because they don't want you to withdraw it. But you will be able to use that money to trade. Now, your profits are calculated on the leveraged amount. So it gives you an opportunity to make more money faster than you otherwise would be able to make. Okay, so it's called leverage. If it's confusing to you at the moment, good. I don't want you to worry too much about leverage. I want you to worry about your own money. Okay. Now, this is money that the broker will not deposit into your client's account, as I've said, but the client's profits will be calculated according to their leverage size. Okay, so just give me a sec, guys. Okay, so sorry about that. I just needed to attend to something quickly. All right, so we've been talking about leverage, and it's basically, it amounts to a loan, okay? Although it's not really a loan. All right, now, traders must routinely study the markets daily in order to formulate ideas on how the markets are behaving and which direction they are moving. Now, there are 3 ways to study the market, okay? You don't just go and willy-nilly buy or sell. You need to study the market, study your charts, figure out where the price is supposed to be going, okay? That is called analysis. So whenever we talk about analyzing the market, that's what we're talking about. We're trying to figure out where the price is going so we know whether to buy or to sell. That's simple. Now, like I've said, 3 ways to study the market or to analyze the market. 1, technical analysis. That is the study of charts in order to find specific patterns. Okay. Market makers move the price in very, very specific patterns. And whenever we are studying the market on a technical basis, looking at our charts, we are trying to find the pattern. Okay. You are going to spend 90% of your time using or doing technical analysis. All right. Number 2, fundamental analysis. That is the study of the overall economy and the factors that affect it. So not only do you need to know what's going on as per your chart, you also need to figure out what is going on in the economy as a whole. Now, unfortunately, since the economy or every economy is now global, that basically means we're looking at one incident or one economic thing happening in one part of the world pretty much affecting or having an effect on most other economies around the world. So not only do you need to know what's going on in your own country, you also need to have an idea in terms of what's going on in the whole world around you. Okay. Fundamental things like political decisions, things like interest rates, monetary decisions, socioeconomic factors, things like unemployment, all those things have an ability to affect the currency. It can either strengthen or weaken the currency at any given time. So you need to have a very good idea of what's going on in the world around you. Okay. We also do that pretty much on a daily basis, but not really all the time. All right. Personally, I don't really focus a lot on fundamental. I know some people that swear by them though. Each to their own, I guess. All right. Now the last one is called sentimental analysis. Now these are people's thoughts, feelings, as well as their emotions. Okay. You also need to have a handle in terms of what other traders around you as well as around the world are looking at, what they're thinking, what they feel, what they see about any particular currency pair. That'll also help you formulate trade ideas. Okay. Hope everybody understands that. Unfortunately, I'm not taking questions in this session. Like I said, just gonna go through the material very quickly. All right, now, once the analysis has been done, trades can then be placed in anticipation of profits being made. Each trade must have a stop loss. That is an order sets a number of pips. And these are what pips are. There are units of measurement to measure the change in price. So whenever the price changes, we measure that change in what we call pips. Okay. So the stop loss and order sets a number of pips in the opposite direction to your trade to protect against losses. Okay. The simplest explanation of a stop loss, it is something that stops you from losing all of your money whenever a trade goes in the wrong direction to that which you said it was going to. Okay. It's a very useful thing to trade with. I implore you to trade with a stop loss all the time. Okay. Second or next, trades must also have what is called a take profit. That is an order set at a predetermined number of pips in the same direction as your trade call to exit the trade and book a profit. So it's basically like you're setting yourself a limit every time you trade. My take profit is $100 or my take profit is 50 pips. Whatever amounts to 50 pips, that's how much money you take from that particular trade or whatever trades that you are trading or taking that day. Okay. Stop loss helps you protect from further losses or incurring further losses. Take profits, they help you book profit. Okay, that's a good way to remember them. Now, if the price of a currency pair is 1.12345, that's a hypothetical number or price. The fourth number after the decimal is the pip. Okay, so whenever you count the change in price, always focus firstly from the fourth number after the pip. The fifth is a pipette, which we ignore. The fifth number is a pipette. A pipette is 1/10 of a pip. It's a very, very small number, which doesn't really make much of a difference to your trading. You can safely ignore all pipettes. Okay. All right, now this is true in every case unless the JPY, which is the Japanese yen, is part of the pair. So there's the price 133.457. The pip, when the JPY is involved, is the second number after the decimal, since there are 3 numbers after the decimal instead of 5. Okay. The third number in that situation is also the pipette, which you still ignore. All right. You still ignore the pipette. Okay, so what I'm going to do is I'm going to break my rule, and I'm going to see if anybody has a question here. All right, so I'm on the chat. Hope you guys can still hear me loud and clear. Does anybody have a question yet? Or are you all good? Okay, any questions, guys? All right, so I take it nobody has any questions at the moment. All right, cool. So we're gonna move on to the last bit of today's session, introduction to charts, and then we should be done by 9 o'clock. Okay. What I will do with this particular recording is I will make it available on the Telegram channel. I created a new one specifically for this, so I'll have it up by the end of today. Okay, so I should have it up in an hour from now. I'll do that as soon as I finish, and then obviously I'll add to those videos pretty much for the rest of this week. So whenever you miss a session or whenever you need to go over something again, the recordings are there. You can just pull them down and go to them again on your own, okay? All right, now charts are a graphical representation of price movement and are what we use mostly to conduct technical analysis where we are looking for patterns. Now, there are three different types of charts. We use either a line chart, a bar chart, or a candlestick chart. Okay, three different types. All charts tell you is the movement of the price or the behavior of the price. Nothing more, nothing less. All three charts tell you the exact same thing. Price movement. Okay. Albeit they do it in slightly different ways. Now, we will be using candlestick charts because the range of information about the price that they provide us, or because of the range of information that they provide us. But for pattern recognition, we'll sometimes use the line chart as well. Okay, so very rarely will we use any of the other two. Mostly we are just going to focus on candlestick charts. All right, now candlesticks are useful in helping us track the movement of the price for any given time period. Okay, so each candlestick gives you 4 different prices for whichever time period they represent. So whether it's 15 minutes, whether it's an hour, or whether it's 4 hours, daily, weekly, even monthly. Okay, they represent, or rather they give you 4 different prices. They give you the open, the high, the low, as well as the closing price. Okay, now the open and the close are represented by the body of the candlestick, and then the high and low are represented by the wicks, tails, shadows, or pins. Okay, now we are going to use the term pins to refer to the pins, or rather to refer to the tails, or the high and low. Okay, so what I'm going to basically do is give you a brief description of what a candlestick is and what it looks like. Okay, so I hope you guys can see the red on my screen. All right, so here you go. This is what a candlestick looks like. Okay, it's going to have what is called the body of the candlestick. And then obviously at the top and bottom, it's going to have the pins. Okay, it can either be green or red. Red candlesticks represent that the price went down. Green candlesticks tell you that the price went up. Okay, so since this is a candlestick where the price went down, the opening price is at the top of the body of the candle, right? Right here, that's the opening price represented by O. Down there at the end of the body of the candle, that's the closing price represented by a C. Now, the pin at the top, that tells you that represents the highest price represented by an H. And then obviously the pin at the bottom tells you it gives you the lowest price represented by the L. Okay, so 4 different prices. That is why we use candlesticks. They are useful for that in particular. Okay, not only do we want to know what the price is currently, we'd also like to know the highest as well as the lowest price that it's been to for whatever period that you are looking at. Okay, so I'm just going to quickly clear this and then we're going to continue. Almost done, guys. All right, now, as I said, the open and close are represented by the body of the candlestick, the high and low represented by the pins. Now, we will focus on 2 particular types of candlestick patterns, those being dojis, or sometimes they're called hammers, as well as railroad tracks. Okay, so I'll show you exactly what those candles look like. So doji candlesticks look like this, or maybe you can call them hammers. It'll help you remember them better. Okay, I don't really mind what you call them. All right, now, They are usually characterized by a small body. That means the open and closing price are pretty near to each other. And then they will have a shorter pin to the one side, and then they will have a longer pin on the other side of the body. Okay. So that's a hammer, and then you'll also have what is called an inverted hammer or an upside down hammer, whatever you choose to call it, where the longer tail is at the top of the candlestick. Okay, so this is what it'll look like. Smaller tail to the bottom. Okay, so these are called hammers. So that's a hammer, that's an upside down hammer. You are more than welcome to call these candlestick dojis as well. They mean the same thing. All right. Okay, so I'm going to quickly show you what railroad track candlesticks look like. Okay, so railroad track candlesticks, they represent a quick movement of the price in one direction, followed by an equally quicker, if not quicker, movement in the opposite direction. Okay, if you've studied somewhere else before, you might know them being called Marubozu candles. Absolutely the same thing. Okay, now like I said, represented by a very quick movement of the price going down, since the first one is a red candle, and then the candle following it immediately is an even bigger green candle in the opposite direction. So that basically means price went down, price came back just as quickly, if not quicker. Okay, so in terms of the direction that the price is going after you see railroad tracks, you trade in the direction of the second candle. So if the second candle is green, you want to be trading going up. Okay. And then if the second candle is red, obviously you want to be trading going down. Okay. All right, so those are candlesticks very briefly. We will cover these in detail once we do the platform. All right, couple more slides, then we're done. Now, any particular movement of the price over time, irrespective of the length of the time, is known as the trend. All right. So when we study movements, we want to know what the trend is. Okay, we want to know which direction the price is going or has been going for some time. Now, when the market is moving upwards, it is known as an uptrend. Another term for an uptrend is a bullish market. Okay, so whenever somebody says the price is going up, they're talking about an uptrend. Another name for that is a bullish market. Now, bulls is another term for buyers, and this market is dominated by buyers, as one should only buy when the price is moving up. Excuse me. Now, when the market is moving downwards, it is known as a downtrend, also known as a bearish market. Bears and sellers dominate this market, where one should be selling only. Okay, so very basic. When the price goes up, you want to buy. When the price goes down, you want to sell. Okay, makes sense, right? Uptrend, bullish market, same thing. Downtrend, bearish market, same thing. Okay, maybe they could have come up with better terms for them. I'm not sure. All I know is those are the terms, right? Okay, very last slide for tonight, and then obviously I'll make the recording available on Telegram. Now, when the market is moving sideways, it is not trending, and this is referred to as the market ranging or being in consolidation. Okay, when the market is consolidating or being in consolidation, that's when it is ranging. It's moving sideways. Okay, so I'll just quickly show you what I mean by that. Now, when the market is in consolidation, one should neither be buying nor selling. Okay, so when the market is not ranging, or rather when it's not trending, sorry, when it's ranging, you do not trade. Make sense? All right, now look, price goes up, that is an uptrend, right? When the price goes down, that is a downtrend. When the price is moving sort of in the same direction, moving sideways, we say that the market is ranging or it's consolidating, right? So that's what it looks like. When the market is going up, you buy, right? Only. And then when the market is going down, you sell only. When the market is ranging, you do not trade. Big fat X over that. Okay, so you only trade a trending market when the market is going either up or down, not when it is ranging. Okay. All right, cool. Very last thing we'll cover, and then we're done for the night. Now, there are two distinct types of trends, however. One is called the retail trend that most, if not all, traders trade, as well as the market maker trend, which is a distinct trend or pattern with which the market maker moves the price. We don't trade the general retail trend. We trade the market maker trend. Okay, so that basically means we do exactly what these institutions of big boys are doing. Okay, so that was introduction. Very, very summarized or encapsulated. All right, how does one get access to the Telegram channel? Please send me a WhatsApp message and I'll let you know exactly how to get in touch, or rather how to access Telegram. I'm gonna need you to download the app onto your laptop though, either your laptop or your desktop, so that it's easier for you to pull the files down. Okay, it's much harder to do that on the cell phone. All right, any other questions, guys, before I sign off for tonight? And then what I will do is I will continue the beginner program tomorrow and Thursday, make those recordings available as well. And then next week, we'll obviously cover some more stuff. Beginning of Feb, we should pretty much be firing on all cylinders. Okay, that's the core training and mentorship should happen over 4 weeks in Feb, and then every other month going forward. All right. Okay, so let's do this, guys. We're gonna end here tonight. Hope you guys enjoy the rest of your evening. I think I got you back in time for Mubango. I'm not sure. I don't really watch television anymore. If you do enjoy it. Like I said, enjoy the rest of the evening. We'll be back together again tomorrow evening. Okay. All right. Good evening, guys.